Welcome to Iron Financial. This is the channel where we help you forge a stronger portfolio, and we do that by cutting right through the market weakness. I'm your lead analyst. Today, we are putting Progress Software, that's ticker PRGS, under some serious extreme pressure. Look, this company is a complete paradox. On one hand, you got financials that are just screaming strength. We're talking record numbers, solid beats across the board. But then you look at the stock chart, and it is screaming weakness, trading near multi-year lows. So our job today is to figure out if this is a fortress built on a truly solid foundation, or if it's just a value trap riddled with hidden cracks that are about to bring the whole structure crashing down. It's time to start the stress test.
So just look at this disconnect. On the one hand, you have the Q1 2026 earnings report. It is a textbook picture-perfect beat. Revenue? Beat. Earnings per share? Beat. And adjusted free cash flow? Well, that hit a record high. By every single traditional metric you can look at, this was an absolute home run. But then, you look at the other side of the ledger, the stock price, and it's just languishing, completely trapped near its 52-week low. It makes no sense. The report is telling you to buy, but the tape, the actual price action, has been screaming sell for months now. And this, right here, this is the kind of fundamental contradiction that separates a brilliant, once-in-a-while contrarian play from a catastrophic portfolio-killing mistake.
All right, let's just cut through all the noise here. The market is pricing this stock like a disaster is right around the corner. So, one of two things must be true. Either the big money, the so-called smart money, is completely and utterly wrong, or there's a fatal flaw somewhere deep in this company's foundation that the headlines are just glossing over. So which is it? Come on, the market isn't stupid. It sees the exact same numbers we're looking at right now. So is this just a massive institutional mispricing, a moment of peak fear that's creating a generational opportunity for the rest of us? And then you've got these private equity takeover rumors just swirling around, which just muddies the water even more. Is that a real signal of deep, unrecognized value? Or is it just noise to distract us from a much bigger problem? That is the core question we have to answer today.
To get to the bottom of this, we're going to break this company down methodically, piece by piece, brick by brick. First up, we'll lay out the full contrarian case, really dig into the scope of this disconnect. Second, we're going to forge the top line, stress testing that entire revenue structure. Third, we're going to inspect the profitability engine, because that's where the real heavy lifting happens in any business. Fourth, we'll pressure test the whole AI narrative. Is it just marketing hype, or is it a genuine growth driver? Fifth, we're going to actively look for cracks in the armor, the real risks that could bring this whole thing down. And finally, after all that, we will deliver the iron financial verdict.
Okay, let's kick things off with the core puzzle. We're looking at a company that is, by its own account and by the numbers, firing on all cylinders. They just delivered a really strong quarter, they're providing solid guidance for the rest of the year, and yet the stock is getting punished. It's being sent to the woodshed. This is the classic contrarian setup, a beat without the bounce. And what that means is the market is clearly telling us it either doesn't believe the good news is real, or it believes that something far, far worse is lurking just around the corner.
Yeah, but let's be crystal clear about what should have sent this stock soaring. Earnings per share came in at $1.60. That's a 3-cent beat. Revenue was $248 million. That's almost $1.6 million ahead of what everyone expected. And sure, okay, the stock popped 5% right at the open, but that evaporated almost immediately, leaving it right back in the gutter where it's been for months. Now, you've got the analysts on Wall Street saying strong buy, but the stock chart itself is screaming get out. Who are we supposed to believe here? The people writing the reports, or the people who are actually putting billions of dollars on the line? Because right now, the money is saying that this good news is nothing more than a fleeting sugar high right before a big crash.
All right, let's move away from the headlines and the stock chart for a minute and start forging the top line. To really understand if this company's structure is sound, you have to start with revenue. This is the foundation that everything else is built on. We need to know, is it solid? Is it growing? Is it durable? Let's get in there and inspect the numbers.
So the top line number for the quarter was $248 million. And like we said, that's a beat against the forecast. In this environment, that is a solid, substantial number that signals stable demand. You have to remember, in a volatile macroeconomic environment like the one we're in, just hitting your numbers is an achievement. Beating them? Well, that's the first sign of a really well-run operation that sells mission-critical products that customers can't just turn off. And what's really interesting here is when you look at the trend, we're seeing a 4% increase in revenue year over year. Now that's steady, not spectacular growth. It's not going to set the world on fire, but this is exactly the kind of durable, predictable growth that comes from a loyal customer base that absolutely relies on your products to run their own businesses day in and day out. It shows the foundation is solid. It's not eroding under market pressure. It's built to last.
Hold on. You're painting this really rosy picture of the foundation, but the most important number for any modern software company, their SaaS revenue, is going in the completely wrong direction. I'm looking at the details in their report, and it declined quarter over quarter. In fact, it's lower than it was in the last 3 quarters. That's not a crack in the foundation, my friend. That is a canyon opening up right in the middle of it. The market absolutely sees that, and it is a massive, flashing red flag.
That's a fair and a critical point. A sequential decline in SaaS revenue is always a major red flag, and it's very likely a key reason for the stock's weakness, no doubt about it. But in this case, we actually have a clear explanation directly from management. The CFO, Anthony Folger, he addressed this head-on during the call. He said it's all noise from the massive integration of ShareFile, which was their largest acquisition ever. Think about it, they had to take over billing systems, clean up years of messy data from another company, and just get their arms around the entire business. He said, and I'm quoting here, "A lot of the cleanup may bump numbers around a little bit." So the argument isn't that the business itself is shrinking, it's that the accounting is just really messy during a huge, complex integration. It's like post-construction cleanup. It's chaotic, it looks messy, but it doesn't mean the building itself is flawed.
So the top line appears solid, despite that reporting noise from the big acquisition. But the real strength, the steel beams and the load-bearing walls of this entire structure is the company's profitability. Revenue is one thing, but turning that revenue into cold, hard cash is what separates a good business from a truly great investment. This is where the heavy lifting happens. So let's pop the hood and look at the engine.
And this chart just brilliantly illustrates the pure power of that engine. Just look at these numbers. First, an operating margin of 41%. Let me repeat that, 41%. That is an elite, world-class number that demonstrates absolutely incredible operational discipline. Most companies dream of margins like that. Then you have EPS growth of 22% year over year. They are growing the bottom line far, far faster than the top line. And the real showstopper, adjusted free cash flow is up a staggering 35% year over year. This isn't just a business, it's a cash-generating fortress.
Okay, I have to admit it. $99 million in adjusted free cash flow for a single quarter is a very serious number. You can't argue with cash, it's real. But a 35% jump in a single year? That doesn't just happen out of nowhere. That smells like a one-time accounting trick, or maybe they pulled forward some cash from future quarters to make this one look good. You have to prove to me that this is real, sustainable cash generation and not just some gimmick to dress up the quarterly report.
And this chart really puts that surge into perspective. Look at this. They went from $73 million in Q1 of last year to $99 million this year. That is a massive, massive leap in cash-generating power. This isn't some small accounting tweak. This is a fundamental improvement in the efficiency of the entire business. It's a step change.
And it's not a mystery, it's not a gimmick. The CFO laid it out perfectly. The cash flow surge was, and I quote, primarily the result of increased collections, particularly from the ShareFile business. You see, this is the other side of that messy SaaS revenue coin we talked about. While they were cleaning up all that data, they were also getting deadly serious about collecting the cash that was owed to them. They took over this massive new asset and immediately applied their own strict operational discipline to it. And now it is gushing cash. That is world-class M&A integration and just stellar execution.
All right, the cash flow is impressive. I will give you that. It's the strongest part of their entire case. But listen, cash from an existing business is one thing. Future growth is a whole other ballgame. And today, every single tech company out there claims that AI is their future. So let's put that story to the test. Is Progress Software's AI narrative just a bunch of marketing hype designed to get the stock price up, or is it a genuine heavy lifter that is actually going to drive this business forward for years to come?
Well, the CEO, Yogesh Gupta, is basically staking his entire strategy on it. He said, "Our systematic approach to embedding AI across our portfolio is delivering meaningful value to our customers." Now pay attention to those words. He's not talking about some future project in a lab somewhere. He's talking about a systematic rollout that is delivering value today. Now that is a bold claim, so let's see if they can actually back it up with any real evidence.
And they did, with a whole list of concrete examples right from the earnings call. This isn't just theory. For example, a giant global beverage company is using their agentic RAG product, which is basically a smart AI system that can retrieve and process massive amounts of information to answer really complex questions, to streamline HR for over 20,000 of their employees. And overseas tax authorities using it to give its citizens trusted answers. A U.S. state government became a 7-figure customer in under 18 months because they're using the Progress Data Platform to save tens of millions of dollars by identifying fraud. A financial payments company is using their tools to secure over $100 billion in transactions. And right inside ShareFile, customers are now using AI to summarize huge documents in minutes instead of spending hours reading them. These are not buzzwords. These are tangible, high-value business outcomes that prove the AI is real and it's creating very, very sticky customer relationships.
Okay, I'll concede the AI use cases are legitimate and they're actually pretty impressive. They seem to be executing well there. But no analysis is complete without looking at the other side of the coin. A fortress can look absolutely impenetrable from a distance, but you have to get up close and you have to look for the cracks. And management themselves pointed to several risks on the call, so let's put those under the spotlight.
First, let's look at the net retention rate, or NRR. This is a critical health metric for any recurring revenue business. Their stated goal is 100%. The result this quarter was 99%. Now look, 99% is fine, it's pretty good, but when you set a target of 100 and you miss, that's a problem. They're blaming it on an isolated churn event. You know, that sounds an awful lot like an excuse to me. So what really happened? Was this a one-time fluke? Or is this the first sign of a bigger, more serious problem with customer retention?
You're absolutely right to be skeptical of any excuse for missing a target. You have to be. But in this specific case, the facts are pretty clear. This wasn't a customer getting unhappy and leaving for a competitor. This was a completely external, unforeseeable event. They had a 7-figure government contract in Eastern Europe for data retention services. A European court then made a ruling that forced that government to stop retaining that specific type of data. The use case for the software was eliminated overnight by a court order. It's a financial hit, there's no question about it, and it definitely dinged the metric. But it tells you absolutely nothing about the structural integrity of the business or its competitive standing. It's not a sign of a broader trend, it's just bad luck.
An asteroid of bad luck, maybe. But you've got a whole meteor shower of risks here. This isn't just one problem, it's a whole series of headwinds that could easily turn into a perfect storm. Management themselves acknowledge the macro uncertainty that affects everybody. They specifically flagged a potential decline in developer seat counts, which is a direct threat to their DevTools business. They operate in a hyper-competitive space, which means they have to fight for every customer. And critically, their whole total growth strategy relies on buying other companies. But the CEO himself said private market valuations are disconnected from reality, which means that growth engine is effectively sitting on pause. Meanwhile, they're pouring cash into debt repayment, $60 million in Q1 alone, which is prudent, yes, but it's also cash that isn't going to growth or to buying back their cheap stock. These are real, tangible risks.
All right, we've done the full inspection. We've pressure tested the top line. We've examined that powerful profitability engine. We've scrutinized the AI story, and we've inspected every crack in the armor we could find. We have laid out the bull case and we have laid out the bear case. Now it is time to weigh all the evidence and deliver the iron financial verdict. Is Progress Software a deep value opportunity, or is it a classic value trap waiting to spring?
This is where it all comes together. On the left, you have the fortress. We're talking about record free cash flow of $99 million, a monstrous 41% operating margin that very few companies on this planet can even dream of matching. They're giving solid guidance for the full year, they have proven tangible customer wins that are being driven by their AI strategy, and they are aggressively strengthening their balance sheet by paying down debt. The financial core of this company is absolute rock solid. But on the right, you have the cracks that the market is clearly obsessed with. The stock itself is telling you a story of extreme pessimism, just sitting there near a 52-week low. That isolated churn event, whether it was a fluke or not, still hit a key performance metric. The all-important SaaS revenue number is messy, and that creates uncertainty. Their core growth strategy through M&A is on hold for now, and they face the same macro and developer headwinds as everyone else in the industry. The market isn't blind, it sees these issues and it is pricing them in with a vengeance.
So here it is, the iron financial verdict. The market is overwhelmingly focused on the cracks. The messy SaaS reporting, the pause in M&A, the NRR miss. It has created a narrative of uncertainty that is absolutely hammering the stock. But our analysis shows that when you look past all that surface-level noise and you inspect the core financial structure, you find a fundamentally different story. The foundation, which is built on massive recurring free cash flow, elite operating margins, disciplined execution, and a tangible working AI strategy, is incredibly solid. The market's fear has created a profound disconnect between the stock price and the underlying strength of this cash-generating machine. We don't see a crumbling ruin here. We see a fortress that's being offered at a serious discount. Therefore, we believe that for the contrarian investor, with the patience to look through the short-term cracks, Progress Software represents a solid foundation for a compelling investment opportunity. As always, do your own due diligence, but this is one fortress that is definitely worth a closer look.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.